Thursday, October 6, 2016, Monaco 64, home of alternative economics and contrarian views. I'd like to talk about the bond market, U.S. Treasuries, which determine interest rates, long-term interest rates, and also Non Farm Payroll. That's coming out tomorrow. That's the U.S. job data that comes out the first Friday of every month. And tomorrow's number is supposed to show an increase of 175,000 non-farm payroll jobs. Unemployment rate expected to remain at 4.9%. I know that's a bogus number, but that's what the market looks at. And yeah, it will be a key number for the markets and also precious metals. If it's a lot weaker than expected, that 175,000 number, we could see all this silly talk about the Fed being ready to hike rates in November. Even November, people are talking about before the elections. And December, I think that talk will just, be just talk. I don't think the Fed, are going to hike rates. And if they do, it's going to be just like last year. They'll do it once, and the next year they won't be able to do it anymore. And last year, gold, after the Fed hiked rates, it bottomed. So we'll have to see. The stock market will probably go up no matter what the number is. But we'll have to wait and see till 1:30 London time or 8:30 a.m. New York time. That's when non-farm payroll comes out. That's a very important number to see what the market does. The reason why I want to talk about treasuries today is that we're seeing treasury yields move fairly sharply higher, and we are back to levels, at least in the 10-year note, we are at 1.74% in terms of yield, which is historically very low. But since the bottom in yields in the beginning of July this year at around 135, we've come up basically 30 basis points. And we're also seeing the shorter end of the curve go higher. 2-year yield is up to 0.85. That's up 12 basis points in the last month. That's signaling that the market, actually, maybe the market is leading the Fed toward the hike, and they can't. But we'll have to see. But in the middle of September 2016, the high in the 10-year yield was 175, and we topped there and we came down almost back to 150. And in the last week or so, we've gone back up and we're right here at 174. The 30-year yield is 245. The high was around 250. So we haven't seen the 30-year move as much, but the 10-year is very important. And why am I talking about treasuries? Well, because it's the biggest financial capital market bonds. They make, stocks are only about 23-25% of global financial assets, and corporate bonds and treasuries and government bonds are the biggest part of the market, and they determine the value of stocks and other assets. They call it the risk-free rate of investment, in treasuries. They call it risk-free rate, which I know it's a bit doesn't really make sense because I don't think it's risk-free, but that's what people say. And so if the reason why stocks have been so elevated for the last 18 months is that interest rates are low, so stocks are discounted at a lower rate. So that means that the prices are higher going forward. Discounted lower rates mean higher prices. But now if, and I've made videos about this before, how, treasury yields or bond interest rates bond yields have come down since 1981 in pretty much a straight line. We have had ups and downs along the way, but it's pretty much trending lower. in a 35-year bull market, which has created this financial bubble that we're in because money has become more and more cheap. And corporations, governments, and individuals like me and you have taken advantage of those dropping borrowing costs to buy things and buy assets. And that's why we've had this financialization of the economy. But in this video about the 35-year bull market in bonds, whether it's over or not, I look back and, there was a 35-year bear market in bonds after the end of World War II, around 1945 to 1945, 1946, a 35-year bear market where rates went up till 1981. So have we seen the bottom in interest rates and the top in prices? Because bond prices are inversely related to interest rates. So we've had a bull market in bonds for 35 years, but we hit a low of 135 this July, and it feels like it's a cyclical, secular, long-term low. We'll have to wait and see. We could still see. Who knows? We could still see Treasuries drop 10-year yield, for example, below 135. But at the moment, it looks like we've bottomed. And the reason why I look at the 10-year Treasury yield, because that's really like the benchmark rate that people look at. What else? The currencies have moved a lot, of course. The pound, we got to a low of 126.01, so almost down to a 125 handle. We started the week around 130 in the British pound. The dollar has moved up as well, quite well against the yen, and we're around 104. The euro has come off today 0.5%. The ECB denied that they're contemplating tapering their QE. There was another one of these rumors and bogus stories coming out earlier in the week saying that the ECB was considering tapering, but that's basically, there's no foundation to that story. So yeah, Treasury yields, I think we need to keep an eye on them, and the 10-year note is right near, the yield is right near the highs we've seen so far since July. So it will be interesting to see, because if the non-farm payroll data is weak, we would, having worked in the markets for over 20 years, a weak non-farm payroll should help 10-year note prices higher or yields lower. It will be interesting tomorrow, to see if we get a weaker than expected number and yields continue to go higher. That's not a good sign. So yeah, just warning people on the bond market or Treasury market, mainly because the mainstream media doesn't cover Treasuries or bond markets too much. The public focuses more on the stock market, but the bond market is the most important financial market in the world. So if you enjoy my video, please like, share, and subscribe. And yes, if you'd like to donate to my channel, there's some links below in the description. Take care.